The U.S. economy in the second quarter of 2019 grew at a 2.1% annualized rate. It was sharply slower than the first quarter's 3.1%, but not as low as had been feared. Just a day before the actual growth rate figure was announced, the GDP Now forecast from the Atlanta branch of the Federal Reserve Bank had been updated to 1.3%. To be clear, a day before the actual growth rate figure of 2.1% was announced by the Commerce Department on Friday, the Atlanta Fed's real-time forecast underestimated growth by 60%. In addition, the real-time projection by the economic team at the New York Fed for 1.5% GDP growth also sharply underestimated actual second quarter growth of 2.1%. How could the smartest economists be so far off in their real-time forecasts a day before the actual figure was announced? What appears to have confounded them was that consumer spending, which accounts for 70% of U.S. economic activity, fueled the strength. Personal consumption expenditures, the key factor ingredients of U.S. prosperity, spiked higher. Despite declines in two of the four factors in U.S. growth, net exports and business investment, the surprising surge in consumer spending drove GDP to grow faster than what generally had been expected. With the expansion entering its 11th year, signs of slowing growth have spurred worries about a recession, but stocks have climbed anyway, as the strength of consumers surprised even the Fed's brightest minds, propelling continued economic growth. The Standard & Poor's 500 stock index has been breaking records, but with slowing growth, the months ahead could bring a dramatic pause in the record-long expansion. Profit estimates on the S&P 500 may need to be lowered by Wall Street, which could sour some investors on stocks. Expect volatility in stock prices during the deceleration in growth, but also be prepared for the expansion continuing, for the possibility that the Fed will get monetary policy right and steer the economy toward renewed strength.